Hello everyone, thanks for checking out my video. The US stock market continued its 2023's rally last week. Many mega cap tech stocks jumped massively higher, with Apple up by more than 5.5%, Meta gained about 9%, Nvidia rose by 12.7%, and the monster of all rallies was Tesla, who skyrocketed more than 30% in just 1 week. Can you believe it? As a result of this tech rally, the tech-heavy Nasdaq index rose more than 4% and closed out its 4th consecutive week of gains. However, here's a quick question. Is this monster tech rally a FOMO rally? As the earnings season press on and Fed's meeting coming up, what should investors look out for? I will be covering all this in this video, so do stay tuned to find out more. Okay, so we had another green week as 2023 stock market rally continues. More importantly, some of the major indices and stocks have cleared their key resistance levels and things are looking super bullish right now. There were lots of breakouts everywhere, with Tesla leading the way by clocking a more than 10% gain for 2 consecutive days, a super rare feat for a mega cap stock. The Personal Consumption Expenditures Price Index that was reported last Friday came in at 4.4%. This is in line with analysts' estimate, and lower than the previous months of 4.7% and 5.1%. This PCE is said to be the data that Fed uses to gauge inflation. Therefore, a lower percentage gives investors further confidence that inflation is cooling and Fed should probably pivot soon. Moving on, this coming week is going to be a huge one for Wall Street as there are 2 key events that could shake things up massively. Firstly, it will be none other than the earnings reports. It is going to be the busiest week of the earnings season so far as Apple, Google, Amazon and Meta are lining up with hundreds of other companies to report their earnings as well as to issue guidance for the upcoming quarters or year. So again, the big tech companies will be in limelight. Meta will be reporting on Wednesday, while Apple, Amazon and Google will report their earnings on Thursday, so do mark your calendar. The second key event is the first FOMC meeting of the year. It will take place on 31st January and 1st February, as Jerome Powell and team will discuss on the next rate hike. Not only that, Powell's speech will be critical as well. Investors will want to know if the Fed is still hawkish or have they turned dovish. Another big question would be whether the Fed will put a stop to more rate hikes. Anyway, the current expectation is that the Fed will raise 25 basis points this time round, with another similar rate hike in March. So if we have any surprise to this expectation, the market could move quite drastically. But even if there isn't any surprise, I am still expecting a significant level of volatility given the busy earnings week. Now let's move on to technical analysis. SPY is looking great at the moment. This is the first time we broke above this huge downtrend line decisively. Remember I always preach about 2 to 3 candles for confirmation? So yeah, we had it, as you can see, 3 candles above the trend line, and that was the confirmation. And eventually, SPY flew higher. What made it more bullish is that SPY broke free from the 250 moving average resistance levels. Anyway, in my last video, I shared that a cup and handle bullish pattern was playing out, and I also mentioned that SPY will likely go above the trend line, retrace back to test it, and if it holds, we could fly. So far, this has panned out quite well. I also mentioned that 408 is the next resistance to watch. So for this week, once again, keep an eye on this 408 level. If SPY can break above this convincingly, it may fly towards the gap at 416 to 417, or even retest August 2022's high at 428. And oh, another bullish sign is that the 50 moving average has crossed the 200 moving average. And this is commonly known as the Golden Cross, opposite to Death Cross. But then don't get too excited yet. As the macro environment continues to be weak, one shouldn't use this as the only indicator to signal that we are ready for a bull run. More confirmation will be needed in weeks or months to come. All said, do prepare for some form of retracement soon. It's not a prediction, as we all know stocks don't move up or down in a straight line. So when the retracement comes, remember the few key levels that I talked about, namely that downward trend line, the 50 and 200 moving averages. All this will serve as a support. Therefore, if bears want to take back control, they have to do what the bulls have done, and that is to reclaim all these 3 levels. When these three levels get breached, the next target would be 385. Personally, I see 377 as a bigger and stronger support. As you can see, it held for quite a while previously. So when this consolidation zone breaks, it will be ugly for the bulls as we may head towards 350s range. But at this point, 350s and 370s range do seem quite far from where we are right now. Therefore, let's not think so far yet. Just keep these key levels in mind and trade or invest what the chart and trend is showing you. If the market is flying like right now, be a bull then. If it starts sliding down, then change to the bear side. Just don't be a permanent bear or bull. Moving over to Apple, it is also looking bullish at the moment as we had 7 consecutive green candles in a row and we broke above this downward channel. But before we all get too excited, let's keep ourselves in check. Firstly, we have broken below the downward channel on a few occasions previously and came back in again. This means that we could potentially do the same thing on the upside. Meaning to say, now that Apple has broken above the channel, there is still a possibility for it to come back in again. As usual, bulls need to see perhaps 2 more green candles for this breakout to be more convincing. And guess what? Heavy resistance level is coming Apple's way, and there is none other than the 200 moving average at 148. Apple actually tested the 200 moving average twice in recent months, once in September 2022 and the other time in October 2022, and it got rejected in both occasions. After the 200 moving average level, keep an eye on the 50% Fibonacci retracement level at 150. If Apple reports good earnings, I think bulls will likely take Apple above these 2 resistance levels and try to charge towards the 61.8 Fibonacci level at 156. And if that also breaks, wow, we have lots of room to run up. But once again, let's not think so far yet. One level and one step at a time. On the other hand, if Apple reports a disappointing result, then there is a high chance that we will fall back into that downward channel, with the first support at 139, which is the 50 moving average. After which, the next level to watch is 136. If this doesn't hold, I wouldn't be surprised if we start heading towards the bottom of the downward channel again, and that's around low 120s, at least. Okay, now let's have a look at Tesla. Since we hit 101 on 6th January this year, Tesla has been on a monster run, and it hit 180 last Friday. That's more than 70% run up in just 14 trading days. Again, I would like to bring back the previous examples of Netflix, Nvidia and Meta where they all rallied from 40% to 100+%. So now Tesla is doing the same thing, and the next question would be, can this run up continue to 100% or even 120% and beyond? To be honest, nobody knows. Let's see if we can get some clues from the technical chart. First and foremost, Tesla has punched through several resistance levels, and the next one is 198. If Apple and Powell don't give us some bad surprise, Tesla should have the chance to run up to 198 or even 200. This 200 level is actually quite a big level in my opinion, and I believe investors or traders may start taking profits. But if say bulls continue to dominate and we held 200, then Tesla could start grinding up to 221. Alright, that was for the upside. Now let's have a look at the downside. But before I talk about the details, let me just share my view on this Tesla's run-up. Tesla was on a parabolic rally and it created a huge gap up in the process. Personally, despite being a Tesla bull, I am not a fan of such parabolic jump and the gap. In case you are not aware, about 90% of the gaps get filled. This also means there is a high chance that Tesla will retrace to fill the gap at around 146 to 154. That's more than 20 points downside from the current price level. And if you were to zoom out the chart, you will see that we had a similar run-up back in March 2022 with 10 consecutive green candles, and a gap up was created too. What followed after was a huge decline from 384 to 207. That's a 46% drop. A quick look at Apple's chart, you will also find a similar setup. Apple had a really massive run-up back in June 2022 to August 2022, where it rose from 128 to 175, about 37% increase. And to highlight, there was a gap up in the process too. So what happened in the next 2 months was that it fell back to 134, giving away almost all its gains. I am not saying this will definitely happen to Tesla, as they say, past performance do not guarantee future results. But all I can say is, history does not repeat itself, but it often rhymes. Again, it's all about probability. For me, I prefer to be on the side where the probability is obviously higher. With that, I actually sold a covered call option contract for Tesla, which is a bearish move. With all being said, I could definitely be wrong even if the odds are on my side, and Tesla may not see their 140s level again. Therefore, I stand corrected. Anyway, some key levels to watch on the downside would be 161, which is a weak support in my opinion. Strongest support will likely be the gap area from 146 to 154, as that is where the current 50 moving average is as well. Again, a retracement from this run-up is expected, but the key question is, how big will the pullback be? Let's see. Next, adding Meta to this week's technical analysis since they are reporting earnings. As with other mega cap tech stocks, Meta is looking bullish. Since we had the huge gap up in October 2022, Meta has slowly grind up to fill the entire gap, and that is pretty impressive. As we await their earnings, it is noteworthy to know that Meta is hitting the 200 moving average resistance level at 153. A good earnings report will quite likely send us above this level and charge towards the gap at 161 to 167. Heavier resistance will only come in at around 183, that's close to 30 points of potential upside. But I think investors should stay cautious as Meta had disappointed us with their earnings on a few occasions. So if they were to throw in a stinker again, keep an eye on the two support levels at around 137 and 123. In my view, 137 is a weak one. 123 will be a better support, with the gap of 120 to 122 serving as a backup support. To also highlight, the 50 moving average is around this area as well, currently sitting at 123. So you get that, 120 to 123 is an important area for Meta to hold if their earnings are poor and the market decides to dump. Below this area, I would say the floodgate will be open and we will be looking at low 100s again. Lastly, a quick analysis on Google. Once again, Google is trying to break above the resistance level of 100, but somehow unable to do so as sellers keep stepping in. When the earnings are out, we should have a better picture on Google's next direction. Good earnings will likely push it above 100 and charge towards the 200 moving average and the next resistance level at 105. Personally, I am expecting some sellers to step in at this area, but if they don't, wow, the potential upside is quite a fair bit, as the next meaningful resistance is at 120. On the flip side, poor earnings will likely see Google going back to low 90s, with 90 as the support. Heavy pressure could cause 90 to break and fall towards the recent low of around 85. Therefore, if the trend changes from bullish to bearish and if you are able to catch it, that's quite a fair bit of downside for bears to profit. Now let's share some of my thoughts for the current rally as well as outlook of the US stock market. Personally, I think investors are turning bullish because they see that inflation numbers are going down, while the economy remains resilient. This translates to a possible pause or halt in Fed's rate hike campaign, as well as a possible soft landing for the economy, which means no or very mild recession. All this have created tailwinds for the stock market. With this being said, I remain cautious, though part of me is loving this rally. As shared earlier, earnings season remain intense, with Apple, Amazon and many other giant companies have yet to report their earnings and give their forecasts. And of course, we still have wildcard or potential landmine in Powell. Who knows, he may do what he does best, to come out and spook and spoil the party. You get the drift, it's not just all tailwinds, there are still some potential headwinds. Oh, by the way, just to share something interesting, according to Bank of America, investors have not fully bought into the stock market yet, as cash held in money market funds has hit a record high of 4.8 trillion. Let's say the data is true and reliable, there are two ways to look at it. One is, can you imagine if this cash start flowing into the stock market? The current rally is probably just the start of something more. On the other hand, it could also mean that this is just a bear market rally with institutions covering their short positions and FOMO investors stepping in, and such rally is not sustainable. Okay, so what do we do next? Well, if you had followed me for months, you would have known that I believe in dipping my toes into the stock market bit by bit as the market was falling, especially towards the end of last year. Therefore, if you had also done the same thing, most, if not all of the good company stocks that you have picked up should be in the green right now. But what about those who did not do it? Perhaps they felt uneasy back then to put their money into the stock market when it was crashing left and right. Is now the right time, or should they wait for the next pullback? Okay, well, this is not financial advice, but if it is me, I would not wait. Because if I were to wait, and let's say the pullback is something bigger, and to an extent where it become a crash, I will be so afraid to enter again. Therefore, why not just dip your toes in now a little bit and add some exposure gradually? Finally, I wanted to highlight that the fear and greed index has reached the greed stage. Remember the famous quote, "Be fearful when others are greedy and greedy when others are fearful," by Warren Buffett? So yeah, I am adopting a skeptical and cautious view of the current rally and is expecting some form of pullback soon. Similar to how I was anticipating some form of rallies when the market was falling towards the end of last year. Anyway, the retracement will come, and when that happens, the million-dollar question would be, will this next pullback be something that is healthy for the market? Or is it something more serious which may lead to a huge decline? What do you think? Let me know in the comment section below. Alright, that's all for this video. As usual, if you found this video useful, please help me with the like and subscribe buttons if you haven't. Thank you.